Hey everybody, Matt Graham, MBS Live, here with you on April 13th, 2020. It's Monday, and or as we call it during coronavirus times, day. So kind of run together, get it? Yeah, I'm not a comedian, but hey, first off, you might notice that the dashboard looks a little bit different today. I'm operating in the new dashboard. I'm not going to make this video about showing off the features. We will get to those videos, but if things look a little bit different, that would be why. And you may see a few things pop up here and there that aren't something you're used to. For instance, if we get a reprice during this time, you'll see it flash down at the bottom of the screen because we're not necessarily going to take an entire window for that anymore. You can still put that window on your dashboard, but it's easier to see at a glance down here now. Anyway, more on the new dashboard by and by. As far as markets are concerned, bonds are quite a bit weaker today, depending on what you want to define quite a bit as. In a past context, yes, they're quite a bit weaker. In the recent context, this is just another day. And how could I say such things? Just pull up a 3-month chart, really, anytime you want to put today's movement in context or any given day's movement in context. I feel like 3 months is a pretty good time frame for that kind of thing. Candlesticks tell more of a story than the line chart, and you can see today's candlestick for 2.5 UMBS is pretty small relative to the recent volatility. It's pretty big relative to some recent candlesticks from, say, last week and then from before the coronavirus drama. But in the medium term or intermediate term, it is just another trading day. And that's even more true if we change the chart over to Treasury yields, 10-year, just a little tiny guy right here, hanging out right in the middle of this consolidative sort of triangular pattern. Does that consolidation mean anything other than this is the general range where treasuries are settling out after a bunch of volatility? No, this is just the general range where they're settling out. Why are we losing ground would be another great question, although it's not really one we need to answer when the candlestick charts look like this. Still, if we wanted to try to answer it, we could say, hey, the Fed is buying fewer treasuries and MBS this week, and whereas they had easily bought more than the market wanted to sell them the past 3-4 weeks, ever since March 15th anyway. Now they are buying maybe a little bit less than the market would sell them. It's hard to say because they don't end up picking up everything that is put out in front of them on offer. But, for instance, in recent weeks, like last week, for instance, they were willing to buy up to 25 billion a day and ended up only taking 20. And before that, they were willing to buy up to 50 billion a day at their highest levels and only ended up buying 36 billion a day. Today is much tighter by comparison, with the Fed buying around 12 billion versus a maximum expectation of 15 billion, give or take. And so far, that's about as tight as we've seen that margin between the maximum buying amount and the actual uptake. And that would indicate, that supply is higher relative to demand compared to the last few weeks. And more supply means lower prices, higher yields. Same thing going on in treasuries, where they're down to buying less than half of what they initially promised to buy or targeted to buy, and not buying as much as the market is offering. So yeah, supply demand 101. As far as the market movement, we could also talk maybe a little bit about stocks versus bonds. Pull up the chart with the blue line versus the yellow line here from Icon, and just noticing that we have a lot of correlation over the past 2 weeks as stocks in blue move up with bond yields in yellow, and maybe a little bit of range finding here at recently higher yields compared to a couple weeks ago. It's neither really here nor there in the bigger picture because these aren't huge moves in the bigger picture. Moving on, something came up in chat regarding the disconnection between MBS and rate sheets. And it's an interesting question, so I just wanted to speak more to it because not everybody's in chat, and I thought it would be a good point to revisit. So we talk about MBS being disconnected from mortgage rates right now, and then the question comes up, well, why are we seeing reprices for the worst today if MBS are supposed to be disconnected from rate sheets? It's a good question, but it has a just as good of an answer, and the short version is everything's relative. The longer version is this. When we talk about disconnection, it's primarily about outright levels, meaning that if we take a look at wherever MBS are, either in terms of price or yield, and compare that to where mortgage rates are, we are not operating in any sort of historical context right now. A chart will tell the story better than I can. This line actually plots average 30-year fixed rates versus MBS yields as calculated by Thomson Reuters, and we've never been as blown out as we are right now. 200 bips higher than yields, and we historically operate in a range centered on 1% or 100 bips. So did I say 200 bips higher? If I did, I meant to say 100 bips higher. So 200 bips outright, 100 bips higher. And that effectively means all other things being equal, and they're not ever going to be, but if all other things were equal and we were at 104 in 2.5 UMBS and the economy was stable and prepayment speeds were stable, that means that if you're seeing 3.5% today, then you could see a 2.5% rate during that stable time. So 100 bips, 1%. That is where the big disconnection is, or the big disconnect. And it also occurs on a reprice basis intraday. And in that sense, it means that we're needing to see more weakness for any given level of reprice risk than we would normally see. Right now, we have reprices in the teens, and on any other day before coronavirus, if we were down as much as we were today in MBS, we would see 20, 30, 40 reprices for the worst. So the disconnection is benefiting us in that sense, but it also refers to lenders setting rates based on things that aren't necessarily MBS related, and that is not something that can be predicted, even on an intraday reprice risk basis. But the bottom line is that, anytime we're approaching a half a point of weakness in MBS, that's always going to be a reprice risk situation. Even if it's not a guaranteed reprice as it would have been before coronavirus, it's still going to connote reprice risk. Bottom line, industry is still figuring out what's going on, and it's going to continue to do that until we see what's what with the forbearance tidal wave. Any relief measures are kind of false hope right now, in my opinion, because even if you do get a relief measure that sounds really good, or one that actually guarantees bondholders are going to get paid really well, really timely, it doesn't guarantee that they'll be able to move loans off their books. It doesn't necessarily speak to what sorts of headaches this servicing burden is going to cause the industry, and it doesn't necessarily offer any assurance about how all this stuff is going to affect prepayment speeds. So there's a lot of lingering uncertainty that the bond market is continuing to price in and will continue to price in until we see how the forbearance thing is shaking out in terms of actual numbers and not so much as speculation. The more forbearance, the more uncertainty. And that has to subside before we can really get lenders dialing margins back down to a historically more normal level. I think once we turn that corner, we'll see some great improvements, and then this whole disconnection thing will be working in our favor as opposed to the other way around. But, I said a couple weeks ago that we were at least weeks, if not months away from seeing that kind of shift, and that continues to be the case. I'm not adding weeks or months to that. I'm just saying, it's going to be a couple more weeks at least yet before things would start looking more normal. It's not to say we couldn't see things in bits and pieces, but industry-wide, general momentum, it's not something that happens super quickly. So take the opportunities you can get if they work for you and your clients in the meantime. Don't get greedy in terms of locking and floating. We're focusing on what works right now, not necessarily on making little gambles that pay off, if that makes sense. It's going to do it for today. Back with you guys tomorrow. Have a great rest of your day.